Where you should have the biggest asset allocation away from cash is, of course, the long bond. Now, again, look at this chart. Just got to show it to you. Just got to look at it for a little while. 10-year bond yield. Ooh. Oh, I mean, are we getting a little excited here? A little too excited, probably. 138. Do I have 133? That's the low end of the risk range now. 133%. 1.33%. From 1.38%, with the top end of the range now being 1.56%. So again, what was support at for a long time was 1.7. Now it's the top end of the range is even at 1.6. So what is that telling you? What's going to happen this week? We're going to have that damn economic data on Friday. We're going to have the jobs report, and people are looking for 180,000. Who cares if it's 180? If it's 180, 120, what if it's sub 100 again? Or are we going to have to call that an anomaly? Or are we just going to have to call the labor cycle precisely what it is, which is a cycle? So again, anything below, I think it's actually, as long as it's below 300,000, you'd still have a rate of change slowdown on a trending basis in jobs. So again, jobs, non-farm payrolls, again, continue to make a series of lower highs versus the all-time high, the cycle high. A little rusty this morning. Versus the cycle high, which was again in February of last year. 100% of the time, great back test, we go to negative on a non-farm payroll growth perspective. And again, we understand that talking about non-farm payroll growth rates, rate of change coming off the cycle peak, this is all Hedgeye vernacular. But again, that's good for you. You don't have to pay attention to what all these other people are talking about because nobody else has had the call for a year now that bond yields would go back to the all-time lows while they're trying to raise interest rates. Those are your top three things. Exciting morning. Exciting.